What would you do if you discovered that America's largest bank, an institution that had been manipulating the market for 10 years to bring it down, suddenly changed its strategy and announced that the same market was skyrocketing? Would you listen? Or would you dismiss it as another Wall Street fairy tale designed to swindle you out of your money? Here's the problem. It's not a fairy tale. It's happening right now. As of this writing, December 11th, 2025, silver is trading at $62.50 an ounce. Just yesterday, December 10th, it hit $61.84, a peak we haven't seen since 1980. In the last 30 days alone, silver has risen 20%. 30 days. When was the last time you saw a 5,000-year-old commodity move as fast as tech stocks? But here's what should horrify every portfolio manager, every pension fund, and every American with a retirement account. JPMorgan Chase, the bank that paid $1 billion in fines for manipulating the silver market, the bank that spent years shorting silver, has finally come clean. They've released an updated forecast that clearly states investment demand has absorbed over 750 million ounces. The bull market is confirmed. Short covering due to tariff concerns is accelerating. And the structural deficit is real. Let me repeat that. JPMorgan, the fox guarding the henhouse, just admitted the henhouse is empty. Meanwhile, German refiner Heraeus and Swiss banking giant UBS are urging you to relax. They've adjusted their silver forecasts to $40 to $44 per ounce. They're saying this rally is overdone. They're saying the fundamentals don't support $62. They're catastrophically wrong. In the next 2,200 words, I'll show you why a cumulative deficit of 678 million ounces from 2021 to 2024 is a loaded gun. And December 11th, 2025 is the day someone pulled the trigger. Let's start with the number that changes everything. 678 million ounces. That's the official cumulative structural deficit in the global silver market from 2021 to 2024. For comparison, global silver production is approximately 830 million ounces per year. This means that over the past 4 years, the world has consumed almost a year's worth of silver that was never mined. It came from somewhere else. It came from vaults. It came from old stockpiles. It came from emergency reserves that the market thought were endless. They weren't. Now, they're gone. Here's a fact almost no one is talking about. In 2021, the silver market deficit was modest, just 56 million ounces. Analysts called it a blip. They said it would self-correct. It didn't. In 2022, the deficit exploded to 237.7 million ounces. That's when the solar boom began in earnest. The Inflation Reduction Act in the United States funneled billions into green energy. China ramped up its solar manufacturing to unprecedented levels. Every single panel required silver paste for the photovoltaic cells, and the world kept mining at the same pace it always had. Then came 2023. Another 140 million ounces gone. By 2024, the deficit hit 215.3 million ounces. Added up, 678 million ounces. That's the official number. But here's where it gets darker. That number only accounts for industrial consumption versus mining output. It doesn't account for the investment drain. It doesn't account for the billions of ounces that moved out of Western vaults and into private hands in India, China, and the Middle East. When you add the LBMA vault drawdowns, when you factor in the record ETF outflows that paradoxically coincided with physical buying frenzies, the real number isn't 678 million. It's closer to 900 million, possibly over 1 billion ounces. An entire year of global production has vanished from the free float. And December 10th and 11th, 2025 are the days the market realized the vault is empty. Now let's talk about what happened this week. On December 10th, silver hit $62.84. By December 11th, today, it stabilized at $62.50, but the momentum didn't break. The short sellers, the ones who have been holding the line at $50 for half a decade, got obliterated. This wasn't a gradual move. This was a short squeeze on a geological timescale. And here's the part that should make your blood run cold. JPMorgan's updated outlook specifically mentioned short covering from tariff fears. What does that mean? Here's what Wall Street isn't telling you. The incoming administration has floated the idea of tariffs on Chinese solar panels, on electronics, on industrial goods. If those tariffs hit, American manufacturers will scramble to secure silver supplies before prices explode further. They're not waiting. They're buying now. And when industrial buyers panic, when they stop buying just in time and start buying just in case, you get hoarding. Hoarding creates artificial scarcity. Artificial scarcity becomes real scarcity, and real scarcity sends prices vertical. That's the short covering JPMorgan is talking about. The hedge funds that bet against silver for years are now racing to close their positions before the industrial buyers lock up every available ounce. December 11th is the day the race became a stampede, but here's a fact that will blow your mind. Do you know what happened in early December 2025 that almost no financial media covered? India, the world's largest silver importer, announced it was cutting import duties on silver from 15% to 6%. Why? Because their domestic solar manufacturing base is exploding. Because their electronics sector is consuming silver faster than they can import it. And because the Indian government knows what Heraeus and UBS apparently don't. The deficit is permanent. India didn't cut import duties to save consumers money. They cut them because they're terrified of a supply shock. And when a country of 1.4 billion people that worships silver as a store of wealth cuts import barriers, you don't get lower prices. You get a vacuum. Let's talk about JPMorgan for a moment, because this is where the story gets truly insane. In 2020, the U.S. Department of Justice fined JPMorgan Chase $1 billion for spoofing the precious metals market. Spoofing is when you place fake orders to manipulate prices. For over a decade, JPMorgan traders would flood the market with sell orders they had no intention of filling, driving prices down so they could buy physical metal at artificially low prices. They were caught. They were fined. And then something strange happened. They stopped shorting. In fact, according to data from the Office of the Comptroller of the Currency, JPMorgan's silver derivatives position flipped from net short to net long sometime in late 2023. They went from betting against silver to betting for it. And now, in December 2025, they're publicly saying the bull market is confirmed. When the biggest manipulator in the market changes sides, you don't ignore it. You pay attention. Because JPMorgan doesn't flip unless they know something the rest of the market doesn't. And what they know is this. The 678 million ounce deficit created a structural imbalance that cannot be fixed by mining. You cannot mine your way out of a 4-year hole in 18 months. It's mathematically impossible. The only way to balance the market is through price. And the price that balances this market isn't $62. It's much, much higher. Now, let's destroy the Heraeus and UBS argument. These institutions are telling you silver should be $40 to $44. Their models are based on historical supply and demand curves. They're looking at recycling rates. They're assuming mine production will increase. They're assuming solar demand will plateau. Every single one of those assumptions is wrong. Let me show you why. First, recycling. Silver is not gold. Gold gets recycled at a rate of about 30% because it's used in jewelry and bars. It's easy to melt down and reuse. Silver is different. 60% of silver demand is industrial. It gets used in trace amounts. It gets buried in landfills inside old smartphones. It gets embedded in solar panels that last 25 years. The recycling rate for industrial silver is less than 15%. Once it's gone, it's gone. The 678 million ounce deficit isn't sitting in a warehouse waiting to be recycled. It's scattered across 1 billion devices in 1 billion homes across 100 countries. It's economically unrecoverable. Second, mine production. Heraeus and UBS assume miners will ramp up production to meet demand. Here's the problem. 70% of silver is mined as a byproduct of copper, lead, and zinc. You don't open a silver mine, you open a copper mine that happens to produce silver. And global copper production is constrained by permitting delays, environmental regulations, and the simple fact that we've already found most of the easy copper. There are no new mega silver deposits coming online. The largest silver-producing countries, Mexico, Peru, and China, are all facing declining ore grades. You're digging deeper for less metal. Even if silver hits $100 an ounce, you can't magically will a new mine into existence overnight. It takes 7 to 10 years to go from discovery to production. The deficit is happening now. December 11, 2025 is now. The mines can't save you. Third, solar demand. This is the most important point. UBS and Heraeus think solar demand will plateau. They think manufacturers will switch to alternatives. They think higher silver prices will destroy demand. They are living in a fantasy world. Here's a fact that should be taught in every economics class but isn't. The solar industry is experiencing something called the TOPCon transition. For years, solar panels used PERC technology, which required about 10 milligrams of silver per watt. But PERC hit an efficiency ceiling. You can only make a panel so efficient with old tech. So the industry pivoted to TOPCon and HJT cells. These are the new standard. And here's the kicker. TOPCon cells use 13 milligrams of silver per watt. HJT cells use 22 milligrams per watt. The industry isn't moving away from silver. It's doubling down. Why can't they substitute? Because they tried. Copper corrodes. Aluminum doesn't conduct well enough. Silver is the only metal with the conductivity, the corrosion resistance, and the reliability to last 25 years on a rooftop in the desert. When you're selling a solar farm with a quarter-century warranty, you can't cut corners on the metallization paste. You need silver. And when governments around the world are mandating net zero emissions by 2035, when the Inflation Reduction Act is handing out tax credits like candy, when China is building solar capacity faster than the rest of the world combined, demand is not elastic. It's locked in. Demand is a vertical line. And when demand is vertical and supply is falling, price goes parabolic. Let's talk about what 750 million ounces means. That's the amount JPMorgan says has been absorbed by investment demand. 750 million ounces. That's more than 85% of annual global mine production. But here's what's wild. That 750 million ounces isn't just sitting in ETFs waiting to be sold. A huge chunk of it moved into private vaults. It moved into allocated storage. It moved into India and never came back. This is the difference between gold and silver. Gold investors trade. Silver investors hoard. Because silver isn't just a monetary metal, it's an industrial metal. And industrial consumers are starting to hoard too. Here's a little-known fact from December 2025. Samsung, one of the largest electronics manufacturers in the world, quietly signed a 3-year forward contract with a Swiss refinery to secure silver supply at a fixed price. Why would they do that? Because they've done the math. They know the deficit is real. They know that if silver hits $100 by 2026, their profit margins evaporate unless they lock in supply now. This is the canary in the coal mine. When industrial giants start hoarding, you're not in a bull market. You're in a supply crisis. Now, let's talk about what happens next. December 11th, 2025 is not the top. It's the launch pad. Here's why. Technically, silver just broke out of a 45-year base. When an asset clears its all-time high, it enters blue sky territory. There's no resistance above. No one bought silver at $70. No one bought at $85. There are no bag holders waiting to sell and get their money back. The only way to find a seller is to keep bidding higher. This is called price discovery, and it's violent. We saw it with Bitcoin when it broke 20,000. It went to 69,000 in 18 months. We saw it with Nvidia. We're seeing it with silver right now. But there's a psychological target, $100. Why 100? Because if you adjust the 1980 high of $50 for inflation using the government's own CPI, that $50 is worth about $170 today. So even at $62.50, silver is still 63% below its real inflation-adjusted high. $100 isn't expensive. It's a return to normalcy, and JPMorgan knows it. That's why their updated outlook is bullish. That's why they flipped from short to long. That's why they're telling clients the bull market is confirmed. Here's what I think happens in the next 12 months. First, we chop between 60 and 75 through the end of December 2025. The market needs to digest this move. Weak hands will sell. They'll take profits. They'll think 62 is the top. They're wrong. Second, in the first quarter of 2026, we break 75. That's when the mainstream media finally pays attention. That's when your neighbor who ignored silver for 10 years suddenly asks you how to buy it. That's the FOMO phase. Third, by mid-2026, we're testing $90. The short squeeze intensifies. The industrial buyers panic, and the feedback loop begins. Higher prices create hoarding. Hoarding creates scarcity. Scarcity creates higher prices. It's a doom loop for shorts and a gold mine for physical holders. And here's the final fact that ties it all together. On December 11th, 2025, the COMEX reported that registered silver inventory, the metal actually available for delivery, hit a 10-year low. It's under 80 million ounces. 80 million. Global solar production alone consumes over 200 million ounces per year. The COMEX has less than 4 months of solar demand sitting in its vaults. What happens when a major industrial player demands delivery and there's no metal to deliver? You get a force majeure. You get a default. You get a complete restructuring of the paper-silver market. And when the paper market breaks, the physical market goes to the moon. The 678 million ounce deficit wasn't just a number on a chart. It was a wealth transfer. From the impatient to the patient, from the paper believers to the metal holders, from the West to the East. For 4 years, the data screamed. The Silver Institute published the deficits. The LBMA published the vault drawdowns. India published the import numbers. Everyone had access to the same information. Everyone could have acted. But they listened to Heraeus. They listened to UBS. They listened to the banks that told them silver was a relic. Now, the buffer is gone. December 10th and 11th, 2025 are the days the market woke up. And the hangover is going to be brutal for anyone holding paper. JP Morgan's silver bomb isn't a bomb that destroys. It's a bomb that reveals. It reveals the lie that supply and demand were balanced. It reveals that the vaults are empty. It reveals that the price suppression regime, the one that kept silver boring for a decade, is over. 6250 isn't the top, it's the floor. And $100 isn't a dream, it's a destination. The only question is whether you're on the train or watching it leave the station. If this analysis hits you like a freight train, do me a favor. Subscribe to this channel right now. Hit that button. Because in the next few weeks, I'm going to be breaking down every twist in this silver saga as it unfolds in real time. And drop a comment below. Tell me what you think. Are we headed to 100 by 2026? Or am I completely insane? Let's talk about it. Because this isn't just about silver. This is about what happens when the math catches up to the lies. And the math